Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Friday, July 12th. And joining me, as always, Dr. Orphe Divounguy, PhD economist. Dr. O, let's go ahead and get right into a conversation about inflation and what you're seeing in the marketplace today.
Yeah, we have. So first, let's acknowledge that we had some good reports this past week where we basically showed we saw inflation coming down faster than expected. And that's just going to create some relief for a lot of families. Why is it so good? It's good because essentially the labor market hasn't cracked yet under the pressure of higher interest rates. We're still creating jobs. The hiring rate has declined, but the jobs are coming from a big increase in labor supply and in the number of workers in the United States. We have more workers, prime age workers, working than we've had in a long time. The unemployment rate is still just 4.1%. And yes, I think it's important to mention that it's increased, right? The unemployment has increased considerably over the past year, right? We were at a 3.6% unemployment. I think we touched that one month maybe. We were stuck at around 3.8%. The unemployment rate was flat at around 3.8% for a while. And so the U.S. economy has cooled, but it's still, the labor market has remained pretty solid, which is the good news, right? We get price decreases, but we get wage growth that now exceeds consumer price growth, and that improves our purchasing power. And I think that's a beautiful thing. Now, the big concern is that if interest rates remain high for longer, those businesses that needed to refinance their debt, right? Those businesses that have debt due this year that were betting on Fed rate cuts, if interest rates remain high for longer and they don't get those rate cuts, they might struggle. And if they struggle, they might resort to laying off workers. Remember, small businesses in America create the most jobs. Small businesses also rely heavily on debt financing as opposed to raising equity in the stock markets. And so that kind of scenario means that if inflation were to persist and the Fed would not cut interest rates sooner, you could risk a labor market that could falter and an increase in layoffs and a bigger increase in the unemployment rate. So very important that inflation returns to target quicker. And we're seeing that this inflation is happening very fast. And the Fed is now having to consider the risks associated with the labor market. And the Fed is going to be forced to recalibrate interest rates and bring them lower. So the market anticipates 3 rate cuts this year. I'm still in the camp of potentially just 1 or 2. But the latest data really, this is 2 months in a row where we've had, last month inflation was basically flat. This month inflation fell, right? Prices actually fell, right? So let me rephrase that. It's not inflation falling. Inflation has been falling. Prices actually fell, right? And so that's, to me, that's a sign that we're heading in the right direction. We're headed there faster than the Fed even anticipated, and that potentially will get a rate cut. Now, remember, the 5.25% Fed funds rate is too high when inflation is just 3%. And so the Fed will have to adjust rates at some point.
Well, out there in the real world, I'm not necessarily seeing prices falling in, the regular day-to-day consumer goods. I just, made my weekly trip to the grocery store on Wednesday. Been out of town for, 8 or 9 days. I would normally go on Sunday mornings, but I just had some things that I needed to pick up. I'm not seeing it there.
Yeah, it depends what you're buying, right? So food continues to increase, but it's increasing much slower. For example, in June, we had a 0.2% advance in food, right? Food prices are up 2.2% over the past year. But still, even that's come down quite a bit, right? The advance has slowed. The big decline came from gas, down 3.8% in 1 month, down 2.5% year over year. So if you went to the pump lately, you probably noticed that in May and June you get some relief.
Not here, not yet. I mean, I literally filled up last night. I paid $4.04 a gallon, which was the best deal that I could find for an A-tier gasoline. I believe I was at a BP station. You know, of course, we're just coming off the back end of the July 4th holiday when gas prices seasonally spike.
But what about, let me give you another one. What about those used car prices that were?
I think that there's something there. And I think that we're continuing to see, some cuts in home prices, but in both cases, in cars and in houses, you're talking about markets that really, really, really climbed over the last few years. So what we're seeing is a little bit of relief against peaks. If they're peaks, I mean, there has been some ebb and flow to the car market, and there absolutely has been in markets some markdowns. I know your favorite people, the YouTube doom prophets, talking about housing markets crashing and things of that nature, and people are still buying houses and people are still buying cars. I think that interest rates are absolutely a factor there. If you have to come up with 9 or 10% on the finance side of a used car, and if you're getting like best deal on a new car, like 6.25 or 6.75 from a dealer on a new car, you're going to think twice. And I think we are seeing some easing on pricing on the bigger ticket items, but we're still well above where we were before this started to take off in 2021.
Oh, of course. And it's always going to be like that. And we talked about this on podcasts, right? A well-functioning economy is one where prices increase at a reasonable pace, right? And that's what the Fed is trying to engineer. The Fed is trying to bring inflation down from a unsustainable pace to a more reasonable pace. And it's working. It's absolutely working. Now, of course, as I mentioned, as inflation cools and the economy slows, it's no longer appropriate to keep the rates that high, that elevated. And so they'll have to cut interest rates.
All right. Well, I appreciate your insights as always. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.